Okay, hello, and thank you for joining us for this latest installment of our T+1 Industry Issues Forum. Today, focusing specifically on FX and funding, arguably the most talked about and linked theme surrounding these shortened settlement times in North America right now. The idea of this T+1 Issues Forum is to answer your specific questions on this monumental transition impacting market participants from around the world, and it is certainly creeping ever closer. I believe today marks just 70 days to go until the deadline. So, yeah, so many issues and questions persist, which is really why we're here today. I'm John Watkins, Managing Editor of Global Custodian, and I'm delighted to be joined today by our partners on this project. We have Access FinTech, BNP Paribas, Broadridge and Sapphire, along with my co-host today, Barnaby Nelson of the Value Exchange. This is the sixth webinar of our series, and all previous sessions are available on demand on globalcustodian.com, and there are still more to come before that May 28th deadline. Now, the way this has worked is we've been collecting your questions via globalcustodian.com and the Value Exchange, and the ones we're answering today via our panel of experts have come in since the new year, and we've grouped them together under this umbrella theme of FX and funding. So regarding these topics, we're really going to start by laying out the basics of the issues at hand. We're going to talk about the various options available to those with concerns, and we're going to discuss everything from cutoffs and deadlines to staffing and much, much more. So really a big thank you to those who have logged questions in advance, and also for the ones you've been sending our way during the webinars. I believe there's a Q&A function that you can use today, and those live questions are certainly making these sessions interactive and keeping us all on our toes. So do keep them coming during the session today, and make them as specific as you like. They could very well be a problem that someone else is having too, and that's really the whole purpose of this forum. So hopefully that's served as a bit of an overview of why we're here. Just thanks again to all our partners on the project. But Barney, I'll hand it over to you now for some further.
Thanks, John. And yeah, as you said, this is a phenomenally important topic, and I think probably I think it's safe to say that those that started talking about FX and funding a year ago can have legitimate right to say, I told you so, because of the fact that this has become one of those things that's gone from not really important to quite important to now suddenly being predominant in the discussion. And to just set the scene, what I thought it was worth doing, just to give a couple of quick stats as we head into this. From the research that we've been doing. I think for me, one of the points, this is taken from the Pulse survey that we ran together with the TMX, DTCC and a number of other organizations in January. But I think for me, one of the things that why we're having this conversation now, to your point, John, is because ultimately, 50%, a month or so ago, 50% of investors outside of North America were really meaningfully struggling to get ready for T1. Why? Because of funding gap differences. So I think, 80% of offshore organizations, or offshore investors, struggling meaningfully with the funding gaps in terms of, what a T1 market does in terms of misalignment with T2 markets and T3 markets. It's really, really, really central. But also the fact that basically 50% of organizations, there you go. 50% of organizations actually really struggling to meaningfully prepare for FX changes. So basically, the ability to actually to move across to pre-funding. About a quarter of the industry is moving across to pre-funding. About a quarter of the industry is moving their FX to their custodians. So there's a heck of a lot of change going on in the FX space, with a big question mark being, so am I doing the right one? Am I doing it right? So I think for me, the two inputs into this conversation. One is basically very much, first of all, are we getting it right from a funding perspective, and second of all, are we getting it right from an FX perspective? So, as you said, as we go through this call, the Q&A tab at the bottom for everyone except for some of the most carefully controlled security organizations in the world, there is a Q&A button at the bottom of the screen. Please do use it to send through your questions, as you say, John, so that either during this conversation or afterwards we can get some good chat going, in addition to the conversation points that we've already had gratefully received from the industry.
Yeah. Absolutely. Thanks, Barney. And we'll get to some of those questions shortly, as you mentioned, but maybe we can start by setting the scene a little bit. You mentioned that these this topic was coming up 2 years ago. It's suddenly rising in prominence for the last few months, and maybe just because the deadline's coming so increasingly nearer. But you're seeing more media focus, more statements, more reports coming up, even in the last kind of week alone. So perhaps just to start with, like I say, setting the foundations. If I could come to all of you individually and just sort of recap briefly on the definitions and core issues. I guess in other words, what are the core funding and FX challenges that we're facing ahead to set the scene? And Steve, if I can come to you, alphabetical order, Axis FinTech first. Would you like to kick us off with that?
Sure. Thanks. So the number one thing we're seeing, obviously, is the funding and the timing of funding. So it all comes down to timing. So on the back of T+1 on the security side being settled, we now need to make a choice whether we're going to pre-fund or try to catch the funding on the back end. So you're balancing the overdraft versus the pre-funding and not being able to use those dollars. So we're seeing a lot of focus on trying to correlate those activities, trying to be interoperable with those activities. So get to settlement as fast as possible, even before settlement, just know that I'm going to be settling, and then also invoking the FX transaction as soon as possible. And we're working with most of the firms on here, right? We're taking data from Broadridge to accelerate the settlement cycle. We're working with Sapphire in terms of trying to solve settlement breaks. So interoperability is key on this for us, and that's where we play as a technology provider and data provider.
Thanks, Dave. Yeah, you're certainly doing some fascinating work over there. Continuing alphabetically, thinking on my feet here. Mirko, I think it's just about yourself, BNP. Welcome to the session today. Would you like to give us a bit of an overview as well?
Hello, everyone. Yes, from my perspective, of course, the things they can be correlated because on the funding, we are seeing mainly two challenges. The first one is the mismatch on the underlying asset settlement cycle in different markets. So when the client is, for example, selling an European asset to reshuffle these on the US market, then there is a funding need because of this. And on the other side, we can also have the same issues when there is a difference between the fund settlement cycle and subscription and redemption versus, again, the asset settlement cycle. So far, this thing has been quite negligible by the clients, but with this change to T+1 is not possible anymore. Whereas on the other side, the FX challenges are linked to the post-trading of the underlying assets. Today, there are 2 days, we all know that, to perform these processes. And tomorrow, we are going to have even less. And each time we go, so for our APAC clients or the persons that are here today, will be even more complicated. And we can go down to few hours to execute what is done today in 48 hours. So it's not easy to go there. We have seen people moving, and this can be quite risky or costly for our clients to move in that direction. That's what we have seen so far.
Excellent, thank you. And George, great to have you on board as well. So would you like to go next?
Well, thank you, Barney. Thank you, John. I echo. Yeah, it's certainly the question now really is pre-funding versus overdraft. I think that there's still a lot of concerns about settlement as well. So I think funding, your timing is perfect. There's still market concerns about funding. I know that a survey that came out recently by the European Fund and Management came out that 40% of the asset flows are still increased risk. And although CLS estimated that it'd be about 1% in that dead zone window of $50 to $70 billion, there were concerns that in shock moments or high volatility, that could be in the hundreds of billions. So I think that's in addition to funding, the market is still very concerned about if we could get an extended settlement window there with CLS. This does remind me a lot too of I'm going back to 1999 when the euro came in, and then we had the turn of the millennium. Then we had trace reporting, and in a very similar way, trace reporting reminds me of this because the windows collapsed. They did it in a more coordinated fashion in a sense. 2002, okay, there was going to be the reporting. Fast forward to 2005, where that reporting window turned down to 15 minutes, which it is today. And I remember seeing, working with market participants at the time, they waited and waited. So my message here is automate as much as possible. I know there's only 2 months left or so, 70 days. I think you said, John, do as much as you can, the much as you can, effort and you can work, and interoperability, as Steve said. Those are things you need to focus on in the next 70 days.
Yeah, 2 minutes. That's the way everyone should think of it. Yeah,
Exactly.
Gabino, last but not least, and I think you've been on every one of our webinars so far, so congratulations for that. But any opening thoughts from you?
Yeah, George is quoting, I think, from one of the articles, or I think CLS mentioned that 70 billion is actually just the EMEA market, does not include APAC. So the pool of FX that needs to be performed at end of day is actually larger than 70 billion. And that 50% number, I guarantee that Barnaby went over at the beginning. At least a good chunk of that is from the Asia Pacific region. So this is the last mile. This is the part that everyone didn't, I would say, respectfully, people didn't think about thoroughly, right? It's the FX component. The securities part, I think people well understood that. The challenge has been because what pre-funding actually means. And so I know everyone says overdraft versus pre-funding, but in reality, I think people are going to want the overdraft over pre-funding. And the reason why is because if I have to pre-fund, I have to pre-allocate, and I have to trade batch process. That means as an investment manager, as a buy-side firm, I'm not focused on alpha, okay? That's dragging the performance of my fund. Okay, yes, my custodian can help me, and there's custodians that are actually going to assist those clients. But if I could wait till end of day, and I think this is where there's technology solutions, and this is where the interoperability play comes in, you can actually do this at end of day and find that liquidity. And we can talk about that more. I know there's questions upcoming. The other piece I'll also set out there is everyone is, I think, confusing the concept of actually the settlement process, which is T+1, versus the operations to do the settlement is T0. Okay. And I know everyone's like rushing to it and they're saying, oh, atomic settlement and whatnot. But no, we're just talking about the operations. The operations needs to be T0. The settlement's T+1. And that means you need collaborative real-time tools, right? Because even if I'm a custodian, I'm a broker dealer, and I could have bought the best, platform solutions, if my clients aren't there to meet me, I'm only as fast as my slowest counterparty. Okay. And so it's about and this is where I think George and Steve and others are going to talk about interoperability, but is there a platform that helps you meet each other at the same pace, right? With the speed, especially if there's brand new accounts, so you can actually do business with one another so that you can work in a T0 fashion.
Thanks, Gabino. And just on that CLS the stat, I mean, we covered it on Global Custodian last week, just to make a plug for the article slightly, but we did point out that it was the custodian deadlines that were leading to that, and then also CLS commented it obviously in that initial research. They weren't quoted, but there's a comment in there, and we've just made that free to read for the duration of the webinar if anyone wants to check it out, regardless if you're a subscriber or not. So.
Brilliant. So I guess moving on to the questions. I mean, I think for me, what's great about the scene setting is it, I mean, obviously many of the key elements have come through, both in terms of the kind of temporal element, but also I think that this is one of those areas where there is a meaningful cost of getting it wrong as well. And so this is why I think it's suddenly now getting so much attention, because ultimately everything else you can manage, but obviously you get some of this stuff wrong. As you said, Gabino, you can be talking about a meaningful, either explicit or implied performance drag that lasts as long as you're getting it wrong for. So I think that's why this is really now at the forefront of people's minds. So to go through, to kick off with the Q&A that's, as I said, very kindly been logged by everyone on the call. The first one I'd like to ask George, you talk about the liquidity piece in terms of the settlements, and the CLS piece and various parts, but what actually are we aiming for from a liquidity perspective? So before we get to a market infrastructure perspective, what are the peak hours of US dollar, euro liquidity in particular at the moment? And as a result, when should we be looking to actually execute, as I said, regardless almost of market infrastructure challenges?
Yeah, great. Thanks, Barney. Well, first I'll say is automation is the way one needs to be prepared as much as possible in terms of having your ducks in a row, making sure that all of your accounts, your funds, your counterparties are as automated as possible. So I think that's the first thing. Without that in place, because one can say, "Oh, I want to execute at 4 p.m. New York," which is the beginning of the dead zone. But if they don't have that in order, they're going to be scrambling to get filled. So the peak hours, though, are certainly 8 to 11, 8 to 12 New York or Eastern Standard Time, 1 to 4, 1 to 5 London or GMT. And there's an overlap between the New York Stock Exchange and the London Stock Exchange. So those have typically been the most active hours and best hours to trade. With that said, that doesn't necessarily help somebody in parts of APAC or Australia, because it'd be in the middle of the night. In terms of execution, I would say again, as soon as possible. So one should plan on trying to execute as quickly as possible. I'm thinking of people that are in Asia. If you're in the United States, you have a lot more time. But if you're in Asia, or North America, you have a little more time. But Asia and parts of Europe, you only have a couple of hours. I think that the trading protocols, again, you have to really review what that stack of technology is that you're using, to make sure that also is equipped and ready to go. I think the communication with you and your counterparties is essential. Speaking to your dealers, speaking to your custodians. I think that's also extremely important here. So, there's nothing that should be left uncovered. And that's what my suggestions are. Preparations is key.
Great, thanks. John, over to you.
Sure, yeah. We'll keep it on time, and great to see some questions from the audience coming in. If they slot naturally into what we're discussing, we'll put them in. But if not, we'll get to them at the end. So, Mirka, I'll come to you next. Many people know they're not going to be able to manage FX in the same way they do now, from May 28th onwards. And I think we've covered some of this in the intro comments and on previous webinars. But the simple question is, what are the options, and how do participants evaluate each of them? And is there a single standout model for you?
Well, let's say that there is no one solution. Depends on how the client is structured. Let's say that the first thing to do is to understand how much of this work can be internalized by our clients, and this can be easy and achievable for global organizations that are already there. For the one instead that wants to go there, that can be highly costly and highly expensive. So it depends, how do you want to handle it? And if you're not there, after you assess risks, you want to outsource to someone, maybe there you may have certain solution, okay? You may outsource to a dedicated broker, or as a DTCC, let's say, is encouraged recently, and also mentioned previously by the other panelists, maybe the discussion with the custodian must be the key. So this is where you may want to start having discussion. And let's be frank, it should not be just a discussion. It's okay, I want to give you the FX flows. And don't get me wrong, I'm a custodian, I would take it, of course. But it's also what if? So I have this plan today. What if things don't go as planned? What I can do? So I think the discussion is really important in this case. And of course, the custodian can offer you a lot of upside, like no cutoff, for example. So the process that you're running today in 48 hours, tomorrow you may have still almost that 48 hours, because you have all the day after also to perform that effect, because your custodian does not give you cutoff. It's a book to book for them. They move the money from your account in their book to their account in their book. So you can call easily before going home on value date of your underlying asset and execute the effects. There is also no payment cutoff. We were mentioning CLS before. Of course, CLS is not here, but this also gives you that relief when the payment must be executed on a gross basis. There is less involvement from your treasury, so there is less cash that you need to put up front. Let's imagine a euro-dollar transaction easily. You may have 6 hours difference before you receive that money back, and your treasury needs to put that money in front of us. So let's say like that. And if you really don't have the structure, maybe the custodian can be the standout model. But maybe not for all the flows, maybe just for part of the flows, but it's something I think that must be explored by the audience, by the clients, in order to have, again, maybe not first discuss the first solution, the backup solution. Not all the flows, part of the flows. Automatically, the same upside can be received also when you do it by voice. So instead of calling, you can call your custodian. You don't want to have an automatic solution. You still prefer to use electronic platform. We have them pay as well. We offer them proprietary platform, or they usually multi-dealing ones, and you can benefit from the same upside. So that's what I like.
Yeah, thanks very much for that.
And if I may add just one point that I forgot, that's really important when you go from custodian here, is the transparency. Make sure that the transparency there and the parameters are matched to what you want and what you're looking for. This is really important, Because let's be clear. When you outsource, you need to be sure that what you want is executed and they are within the limits and everything that you've done. So make sure that everything is what you want, and then it's, yes, the perfect solution maybe.
Brilliant, thanks. And I'm happy to get some more thoughts on this. I think it's a pretty big topic. Gabino, maybe you had some more thoughts on how to evaluate some of these options.
Yeah, if I was a buy-side firm in APAC or EMEA, the way I would look at this is there's cash management concerns, so that's always going to be a factor in all this. But the way I would first say is, do I want a pre-fund or do I want to consider the credit line for the overdraft? Those are, my camera does automatic animations with my hand gestures. Sorry about that. I got balloons when I put fingers up. But in any case, if I'm a buy-side firm, I have to consider those two. Depending the path I choose is where I'm going to go. If I go the pre-funding route, then most likely I'm going to be captive to my custodian. I could look at options with third-party FXs, right? But if I have accounts that are not already serviced with them, there's going to be an onboarding challenge for some of those accounts with the third-party FX, right? And then that means if I settle with my custodian, am I going to give them my full day's trades and can they support me, or am I going to be trade batch processing throughout the day and sending that to my custodian as interim, or maybe portions of the day is going out to the market to kind of try to get best pricing, transparent pricing, and then leave the last 2 hours of my day to go through my custodian. The alternative is there's emerging solutions where you could wait till end of day. You don't have to pre-fund. You don't have to pre-allocate. You don't have to trade batch process, right? And amalgamate your securities-based trades. Don't double book your FX with the FX standing instructions you may have already with your custodians, those 11A instructions, right? And then go to market with pricing from a pool of providers who can actually meet you there, and then use the credit line there for only a 5-hour window for those APAC clients, like a firm that's based in Tokyo. 4 p.m. New York time is 4 a.m. Tokyo time, right? If I then settle an arrangement that by which, for example, I have let's say a standard deviation of the pricing for the FX, I could auto execute against that, have a credit line that's open with a 5-hour window before the cash is then moved between the banks when my bank opens up 9 a.m. Tokyo time, 9 p.m. New York time. And these kinds of solutions are coming to the forefront. The concern on the street around this is there isn't liquidity after 4 p.m. But we already know, George named the numbers earlier, 70 billion in the EMEA market, even more than that in the APAC market. And the spreads are wide, but after May 28th, you're going to see the spreads narrow because the demand is there and people want the optionality. Right now, since that market isn't, since the deadline has not been hit, we're not observing it, but we're going to be able to observe it post May 28th. And I think in the latter months of the summer, then we're going to have a real market coming to play, and that's where these solutions are going to come to the forefront.
Brilliant, thanks. Barney, George, anything to just add at all on that? I know
I think that's really well said, Gabino. I think that you bring another perspective here. What I see here is that one has to be open to flexible alternatives, and that's the key here, because the custodian is going to add a lot of value, so we can't discard what that they can do for you. At the same time, do you want to put all of your flow to one particular resource? No, you don't. And no offense to any custodians, they do a great job on the most part. But Gabino brings that new perspective, which is quite interesting. We'll see maybe even a widening of spreads in the first few days or hours, but the market's smart. It'll correct itself very quickly. And so as long as you have your access to data and your analysis, you'll be able to get the proper formula. What's the right distribution in those hours?
No, brilliant, George. I mean, I think that what's the proper formula, I think, is so key. That I think for me, particularly in more middle-sized firms, there's such a tendency to basically more or less say, okay, I need a silver bullet here. I need the right model that everyone's using. And as you said, it's a formula, not a kind of silver bullet. But I mean, obviously, we've touched on the custodian FX, and as I said, 25% of the industry moving there certainly is a short-term piece, but always with that kind of tinge of this being the worst possible option, la-di-da-di-da, I'm going to get ripped off, all this kind of stuff. Fortunately, we've got Mirko here, who is a custodian, who can explain to us why, as you said, George, it's a very valid option, but particularly from a regulatory perspective, one of the questions that's come through is if you do outsource your FX to your custodian, how can we stay in line with MiFID? How can we stay in line with best execution rules? And ultimately, how can we make this a good option or sell it internally, if you like?
Sure,
Sure, I can take that for sure.
Sorry, I meant to say sorry.
First? Josh, you go first. Sorry. George, you can go first.
George, give us your view, George. I mean, you've kind of touched on.
Bad.
Go on.
Yeah. So, from a regulatory perspective, and again, it's a lot about data, and we can't underestimate the importance of data. There are resources out there today that I think many of them will continue to be applicable, whether it's TCA and you're doing your analysis, your timestamps. Independent sources, I think, are extremely important too. As many sources as possible. And that's why I wanted to actually point out the importance in this. This is an industry-wide change. It's not just banks, asset managers, brokers, platforms, but the data and the contribution also will play a key role here, because I know how tempting it is, and having lived and worked in New York for many years, at 3:00, 3:30, people kind of let their guard down, and the traders in particular, they worked hard all day, and then now it's time to stop and have a cup of coffee or a cup of tea. It's not that they're leaving, but it's going to be critical to continue to price. And I think Gabino definitely referred to this before. There will be this change, and you'll see the market makers and the dealers and the platforms to increase that pricing in that dead zone of 4 to 6 p.m. in New York. So that'll be really important. But again, do your analysis. It's not a perfect science, but use the tools that are out there, TCA, data, and adjust accordingly.
Brilliant. No, thank you. And Mirko, your take on all of this?
Sure. No, I totally agree on what has been said for sure. The data out there, they're also provided. They can help the clients to analyze that. Then if we look at it from a regulatory perspective, let's say like that, where we talk about, in this case, funding your trades, we are really not talking about best execution, because they're excluded by definition. It's not an OTC, so there is no best execution on the spot. But that being said, and then back what George was said, that doesn't mean that you can receive all the price you want. As you said, I will be ripped off my custodian when it's going to happen. That's for sure. As I was telling you before, transparency is the key. You need to know what is going on, and usually you make sure that everything is backed by a contract, and is giving you also maybe alternative pricing solution. As for example, in MPay, we offer you not just the classic market, we can offer you more transparent fixing as a reference rate, or even algos. So if your concentration with the custodian should go above the threshold that has been mentioned below, because for any reason you need to concentrate more flows and you want to differentiate and have access to more liquidity, you can go through algos, for example. This can allow you to have a better execution that you should receive with a big up. So again, the transparency can be there. It's a two-way. Of course, the transparency should come from the custodian, and there are also tools outside that can be easily crossed. And also some can offer you also post-trading platforms where you can extract all the reporting, and you can cross-check with your data provider and make sure that everything has been respected. So again, it's transparency should be the key for me. It's the right word there, in my opinion.
Brilliant, thank you.
Great, thanks all. The next topic is, I think, something that's been talked about across investment operations conferences. I've seen articles in the FT about it. But Steve, if I can come to you on this one, what changes do firms need to make to their global staffing model to enable smooth FX? I guess it could be before or after May 28th.
I think on the staffing model, it's going to be key to see what infrastructure you have, right? And where it is. So, we've had banks that said, okay, we're going to move people out to California, but we see that the data isn't actually in the platform before California time zone. So, those are things that we point out to them, like that operating model doesn't really align with what your data is sending. So it's important to understand what your data is going to be doing, as George keeps, referring back to, and then also what your target operating model of your users are going to be doing. So get your data in place and then decide how your target operating model of your users is going to react to that. And that goes for whether you're an outsourced admin or whatever model that you have. So that would be my recommendation, is just look at where the data workflow is, look at where the breakpoints are, look at where the data is, when is it in certain systems, when is it available, how interoperable is it? Do you have a single place to see it and react to it, or are you context switching? And then also with all of this data correlation, and we're starting to break down the silos of different processes, right? FX and settlements for me is like great, because like we've always thought about operational activities separate. We've thought about the asset movement and we've thought about the cash movement. And typically they're separate. They're never like, no one ever really thinks of them together, right? We deal with our cash breaks and then we deal with our asset breaks. This is a place where we actually have to deal with it together. Like this is forcing us to think about it really as one. So that's super interesting in this model. So, again, I would just look at making sure your users are looking at the right systems and trying to compress the context switching down as much as possible. But also, you have to review your operational walls and say, okay, did we build walls that no longer make sense? We have to knock those walls down and start thinking about these processes different.
Great, thanks.
Yeah. And I guess if I may, so carrying on from that, I mean, coming back, Mirko, to you, I think, talking about building walls and, one of the walls that was cited last Friday in the paper was, as you said, John, was custodian FX and the deadlines around that piece. I mean, Mirko, how are you seeing custodian FX deadlines moving, changing to Steve's point in terms of actually keeping up with the change?
Yeah, sure. I think that we must separate what is if the custodian is not your broker, as I was mentioning before. In that case, you need to respect, of course, the cutoff of your broker first, and the one of your custodian. So the restricted one must be respected. And then I don't think it's gonna change at the moment. Then depends also on now if the broker will be able to offer more liquidity in that moment of the day, as has been said to after. But of course, the market usually adjusts, as mentioned before. Whereas for when the custodian is also your broker, as I was mentioning before, the cutoff is not a problem at all. You can take your time to execute your FX, and usually on top of that, you don't even need to handle the payment, because again, it's a back-to-back. So there is even not that burden of the post-trading that must be carried out by the client. So again, for me, there is if we make the distinction, they can be treated completely separately. One is a pure custody payment issue, and the other one is a product issue, that is the FX one.
Barnaby, if I could just add real quick, Steve said something very important earlier about understanding where your data is at and your operations. It also matters like how you're structuring that information. I'll just give you an example. What's missing a big part in the industry today is being able to link the security trade with the FX trade. Okay, but again, you heard George and Steve talk about interoperability and whatnot. What if I told you there's solutions that actually can link the security trade with the FX trade, and that your custodian doesn't have to be confused in terms of the sequencing of these activities, because they don't know if they can move the asset until the PVP is done to do the DVP, the PVP payment versus payment, DVP delivery versus payment, right? And then depending on the options or solutions that investment managers choose, broker dealers or custodians, you might be able to actually not set up a North America desk. Just maybe start end of your day, have someone working until 7 p.m., 10 p.m. your time, to kind of make sure that the automated process kicks off and go to sleep with ease and peace of mind. Now, some firms may say, hey, you know what? I'm just going to go with my custodian to Mirko's solution right away. They can handle it. I don't have to worry about cutoffs and whatnot. Others are going to say, well, you know what? I want to maximize alpha, so I'm also going to look at these other options. And the custodians can still play in that role, by the way. When I say liquidity providers, the custodians are members of that community, along with the broker dealers as well, right? Because there is liquidity after 4 p.m. New York time. It's just not attractive to anyone at that point, right? In terms of the spreads. So that was the other point I want to bring up. But and again, like when people are thinking about where they're setting up their data, it's just kind of like, okay, well, what's my operating model? Is my operating model, defaulting to custodian peace of mind, or automation for focusing on my alpha, going to market, and then kicking out something off before I go to bed at night? So.
I wanted to add that it's come back to now the funding and the foreign exchange, where the asset classes, it's brought how these asset classes are much more interrelated. For many years, FX was the afterthought. Oh, let's get the equity. Let's buy the Vodafone, or let's buy the IBM. let's buy those corporate bonds. And the FX was afterthought. FX now is in the forefront. And if there's ever a business that's still a relationship business, it's foreign exchange. And I do want to reiterate how important that is, the relationship with your custodian, with your brokers, your counterparts, with your technology providers. Those relationships and that channel of communication need to stay wide open. And again, you'll make those adjustments, but you'll probably be involved with all three of those areas of the business, as I said.
All right, thanks everyone for that. George, I'm going to stay with you actually, and obviously we mentioned it's the North America shift and not just the US shift. So one of the questions we had in was, what do we expect to happen with Canadian dollar and Mexican peso liquidity after May? And are there any specifics that participants need to be watching for with these currencies?
So May, I think the end of May is the Stanley Cup playoffs, right? I think we're going to be in big trouble with the Canadian dollar. No, I just had to throw a little bit of levity there. But let's think about it. The Canadian dollar is sixth most active liquid currency in the world. The Mexican peso on any given day is a top 10 currency. It's certainly, it's the third most active emerging currency in the world behind Chinese renminbi and Indian rupee. Again, though, those are during the busy hours, right? That 8 to 11, 8 to 12 New York window where you have that overlap with London. It will be challenged. Again, the main participants in this market, whether they be in Canada, United States, Mexico, will need to be active in that market, providing liquidity. It'll depend on the other, if we're talking about an Asian currency versus CAD, the dollar's in the middle of those trades, 85 to 90% of the time, but that will also, put a stress on your liquidity. So again, I think the market will adjust. The market is smart. It will certainly adjust. They want business. And, maybe spreads will widen in the beginning, but we should see some normalization after a couple of days, or who knows, it could be within the given, first day or two.
Brilliant. No, thank you for that. It's always it's good. I won't ask you about the Argentinians as well, who have put their hand in the ring, but we'll move on to a question on a time cycle. So a lot of what we've talked about is the formula, if you like, and basically the model running up. But of course, we're running on a deadline. And so one of the questions that's come up is ultimately, basically what happens after May. So Steve, I mean, you talk about breaking down the barriers, and I think and the walls. For me, this is so critical that it makes so much sense, as you say. We've got to reimagine a little bit how we manage this stuff, but ultimately there's only so much we can get done before the Stanley Cup playoffs and then afterwards. So what do you see in terms of actually what we are going to get done pre-May 28th and then post?
Sure. So I just look at what we've kind of already done as an industry, right? So if I look at kind of what we call intent to settle, right? So I made a good point about the difference between the settlement cycle and the T0 operations, right? So if I look at what we have, security-wise, equity and fixed income, 70% already of the global settlements are running through our system with intent to settle minutes after they actually execute. That's going up to 90 before May. Now, what is populating that data? Broadridge is populating a lot of that data through their settlement platforms. The likes of BNP are populating a lot of that data. What does that give us? It gives us now the ability to start triggering out to the FX providers for executions. Okay, what should you do? So again, all on T0 minutes after the execution. And now we kick off that cash process. Okay, now the likes of Sapphire come into play. They have SSI set up. They have organizations set up on account management. So now we have that. Do you want to compress the FX before, or do you want to compress it after on the operational process? All of this can happen, and all of this can be linked through data. So you can take your equity or fixed income settlement with your cash movements, with your netted cash movements, and also the status of the actual cash movements and settlements, and tie it all together in one place, and then it can be distributed to wherever you want to actually look at it. So all of these firms are interconnected. So I think the industry's done a lot of things, and what we have now is FX providers asking us to send them notifications. So as soon as it's an intent to settle, can I tell my asset manager to to ask to invoke the FX transaction. So that whole interoperability of multiple systems all taking place with data being collected, like for me, changes the game. As I said, like for us, we're going to be about 90% of the settlements market before May. So like for me, I think the industry has done it quietly. I've definitely seen an uptick in urgency since January 7th. People came back from kind of that break. And I think in the last 8 weeks we'll have stuff, but there's going to be some hangover. There's going to be some stuff that we do after, and it will drag on. And I think some of the firms will change operating models. So anytime we see regulatory change or anytime we see change, people will build stuff and scrap it together because they're unsure what to do, and then they'll come back afterwards and say, "Okay, like that was a bad choice." So we're getting an uptick in CSDR stuff now because people build stuff that they don't want to maintain anymore. So there's definitely the after, but I think we've done a good job the last few years. This is not like months that's been going on. This has been going on behind the scenes. And what's interesting is a lot of the service providers initiated it. So the buy side, speaking last week at InvestOps, the buy side weren't even aware of what was available. So that's the message we're trying to get out. And I think Camino's doing the same thing, and Brothers is doing the same thing.
Thanks. We had some audience questions come in. Gabina, I'm going to try and combine a couple here for you, but I'm just going to read them verbatim as they come in. The biggest problem I have with T+1 is when I sell into a T2 market and buy in a T+1 market, as that gives me a day of overnight funding costs from somewhere. How did we solve this in previous T+2 transitions? And then if I could just read this other one we've had in from the audience as well. Do you think that FX funding can be a solution to cover the liquidity gap between the asset liability settlement cycle, the sales in T+3 and underlying asset settlement cycle in T+1? We'll try and post those questions somewhere actually if we can as well, so people can see those. Did you get that all down?
I'm gonna try to tackle it. Let me do the second one real quick first, because I think people have questions around subscriptions and redemptions when there's a T+1 versus T+2, T+3 scenario. When you look at an ETF, that's a lot easier because the subscription and redemption model is going to be pretty straightforward. It's when you get to mutual funds or whatnot, or when you're buying the actual assets. What's possible in a T0 operating model is to track the obligation. That's the way I call it, right? It's not the actual settlement. It's tracking the obligation of what needs to settle when. So if you've executed in a venue that requires T+1, like the US will be come May 28th, then you can track the settlement of that. And clearly you need to do that settlement within 24 hours, right? For a market where it's T+2, my recommendation to firms, when Sapphire approaches, I know Access FinTech is doing this as well, and I'm pretty sure because I know George, he's probably advocating the same. This should not be when people heard T+1, they were thinking one model for the US market and Canada, and Mexico, by the way, has already said verbally that they're going to align with the US and Canada. Okay. One model for this, and maybe India, and a model for the rest of the world. But the rest of the world is coming on to T+1. So you might as well look at your entire operation as a T0 operations, okay? Because this solves a lot of that problem. And by the way, George said it earlier, unless you're doing automation, you got to have a high-performing, high-communicative team that can track all this without just throwing labor, because that's going to cost you a lot of money. So, anyways, the point is that if you have a digitized model that can help you in real time collaborate with your customers, and there's really five major parties I've been talking about all the time, right? I keep saying this, but you got the buy side's outsourced middle office where they apply, the buy side's custodian, the sell side, and the sell side's custodian, right? Everyone says custodian, but there's really two on every trade, right? So, and the two custodians need to be able to view the resolution of these trades. And I'll give you another quick example of this, where there's inventory management issues. So that we talked about this at InvestOps last week at the conference. There's a fallacy in the street that when you affirm the trade, that's the end. There's inventory management issues that can happen after affirmation. This is stuff that I know Access FinTech has been very focused on to help resolve for a lot of the liquidity provided to broker dealers on that side. But at the same time, if you don't have that resolved, how can you possibly do the FX? Because it could be a different account that you're moving the assets to be able to satisfy those reconciliation issues in the settlement or inventory management case. So if you have that in place, if you have real-time technology between yourselves and those five parties I talked about, then you can track those obligations. And then it's just a matter of the redemption subscription model. The only one that's a big challenge is in the European market UCITS, in my personal opinion. The UCITS is a unique situation, but put UCITS aside, everything else can work in this real-time model that I just described, right? And this then answers the question around the funding question, right? And Mirko said it earlier. George and Steve touched on this before as well. If you, and my answer earlier too, you got to figure out which path you want to take. Is it the custodian model, take care of me, give me peace of mind, pre-funding trade batch processing, or is it going to be, hey, alpha focused on my funds and using a credit line to get best execution on the FX on the back of it? And then so long as you're digitally tracking your obligations, you can't mess up.
Brilliant, thank you. And so, I suppose following on from that, I mean, the underneath the surface, basically, we've talked a lot about basically covering the funding the trade and all this kind of thing. But there's also, I mean, we touched on, you mentioned, Gabino, this kind of the performance drag piece. And so essentially, what are there kind of off-the-shelf solutions? So the question is basically, what solutions are people looking at in the market to resolve the T+1 to T+2 funding gap issue? Are fund managers pushing it back on their brokers? Kind of following on a little bit from what you were saying, Gabino, in terms of relationships. Basically, are people pushing it away? Can you just basically deny that the problem exists and make it somebody else's problem or not? And therefore, how do you avoid the funding gap issue overall? So, I mean, George, do you mind maybe just giving us your thought on that?
Sure, and I would certainly I welcome everyone's contribution here on this subject. Yeah, I mean, we've covered a lot of it, I think, in terms of is the pre-funding, with high interest rates, what is the opportunity lost with the pre-funding? At the same time, the overdraft, again, higher rates, they don't seem like they're necessarily going to go speeding down the next couple of months here in the United States, at least. So there's that. There are other, costs involved. Opening a U.S. desk, it doesn't seem to make sense. And I think Gabino mentioned earlier, you don't need to necessarily open a U.S. desk. You could have people stay a couple of extra hours in their hour, in European or APAC times. It also depends on the scale, though, the size of your company. If it's a smaller 10-person asset manager sitting in Singapore, you're probably not going to want to open up a U.S. desk. Whereas if you're part of a larger organization, you may have the resources that you may have people already on the ground on the West Coast or on the East Coast where they can help fulfill some of that activity. Something that I wanted to throw out there, though, that we should think about, and I don't think the market's necessarily ready immediately, but think about innovation. Innovation will come out of it, and digitization is critical. And some of the things that we're hearing are in terms of currency wallets, digital currency wallets. So if people have a little more knowledge in that area, I'm certainly welcome to talk a little bit about it. I've heard it from, in the last few weeks, I've heard it from major tier 1 banks that are really keen on pushing the digital currency. And I've also heard other types of providers that maybe came from the blockchain crypto world, which are also looking to provide a service here with digital wallets to serve as that bridge between the fiat currencies. I'm really interested to hear what anybody has to say on that subject.
Yeah, that's brilliant forward look. Yeah. I'm looking around to see if anyone's putting their hands up.
No one wants to say it, but I do see some digital currencies as a way to protect purchasing power and a way to be an intermediary for exchange against fiat currencies. That's a trend I'm seeing. That's why I think we're seeing Bitcoin hit new highs, because there is inflation in the market. And Bitcoin in particular, this is a finite number of them. So that's where I see some of the activity happening right now in terms of that. And that's a new type of arbitrage I think we would see in the market. Now that you see the SEC blessing ETFs against Bitcoin. So that's making it a little more ubiquitous. But I'll leave it at that before I go any further on that topic.
Well, I mean, and just to expand on that, there are proven examples, for example, in the repo market. Forget about the currency itself, but using technology with smart contracts. I think that'll certainly put the currencies aside. Let's stick with the fiat currencies. Let's stick with the traditional finance as we know it. but we're talking about technology here. And if technology can trigger those payments through smart contracts, then that is something that's going to be explored more and more as we go down this path.
Yeah, no, it goes back to Steve's point in terms of, I just keep saying it, but removing walls, breaking down the walls. I mean, at the end of the day, technology there's several generations of technology available today to rip those out and to, as you said, program the entire process. That's a great forward-looking angle. Thank you.
Thanks. So, right, I'm going to try and speed up the questions. George, try to resist opening up to the floor. But Gavino, next question, if I can just kind of shoot this to you quickly. At the moment, my access to funding and my custodian is uncommitted and undisclosed. Are there any solutions out there to cover my funding gaps using secured funding, specifically for T+1? I know this might be things we've gone over already.
Yeah, honestly, it's the same thing. It's just you have folks who are concerned about the uncommitted, undisclosed situation, right, with their funds. You're going to want to have bilateral contractual arrangements either with your custodian or liquidity provider. And I said it at the beginning, you think about your path. You want to pre-fund, pre-allocate, trade batch process, and then go to your custodian, or do you want to focus on alpha, look at the credit lines that are available for overdraft, and embrace some of the technology solutions? And I will say one more call out, Broadway just certainly has solutions. I know for a fact Access FinTech has solutions. Sapphire has one. We're coming out with announcements come May 1st. So there's going to be stuff out there for the folks to learn more about in the coming weeks.
Thanks, Gavino.
Great. So just in the last few minutes that are left, if anyone does have more questions come through, we've got one more question from the online log, and then we've got another question that's come in on the impacts in South Africa, which is pretty fascinating. But before we do that, one of the things that we've talked about, we've talked about all the various models and we've talked about all this kind of various pieces. But I think if you pull together, anecdotally, if you pull together everything we talked about, growth in bilateral FX, growth in probably SEC lending volatility means probably more margin being called, more treasury being called, pulled down on both of those. I mean, ultimately, is basically, first of all, is there likely to be any major kind of do we expect a big increase in the amount of margin that we're being called across the various activities, both cash equities, FX, and SEC lending after T1? And second of all, how are we going to be able to track this as an industry, both in terms of disclosures? So, Mirko, I don't know if you have a view on that.
Yes, from an FX perspective, in terms of margin, I don't see a big issue because again, we are talking about non-OTC product if we talk about funding. So margin is not required by definition. So I'm not expecting. Then if by margin we expect how much the spread can be charged to my trade, that depends, as has been said before, by the liquidity. Maybe at the beginning the bid-ask spread can be larger if the market is going to adjust and there will be more liquidity. Of course, this spread and this bid-ask margin, bid-ask spread can also go down. Also, the security lending, actually, I don't foresee any big change because the security lending is already handling recall on T0, for instance, so both from agency or principal lending that you may do. And so I don't foresee any big in that. Maybe on the sell side, maybe you may need but more on when you sell an asset. When you have a recall, maybe you need a fail covering product that may help you to cover that sale. But and that can be an additional cost, but it's a facilitator also to help you to deliver back the shares to the market. So this is how I read this question and I would answer. Then for me, these two products like security lending and repos, as mentioned before, may have a big impact in the future. We're talking before about how can I avoid drags on my performance, on my funds. Maybe you want to start looking at these access. You want to start looking at on your assets. You are not doing any security lending program, agency or principal that is. Maybe start doing that. That can help you, maybe can help you to compensate because you cannot avoid cost and disclosures, credit lines. So if you want to pay for a committed credit line, you must step them if you want to, but maybe you can offset that cost. You already have it, maybe try to enlarge that collateral schedule, move from the usual bonds to something equity or lower grade bonds that can help you to maximize that. And the repo on the other side, you can take cash to cover. So look at your assets, you can outsource the repo execution or you can do it by yourself, and you may have the liquidity that you need to settle your trade. So I think that the market is offering you solution. You may have it through your custodian again, you may have through external provider, fintech, whatever. We are all there. we are all facilitator at the end on the market. So I think it's just a matter of in that discussion with all the players, been said correctly before. Let's discuss with all your provider, custodian, and then can help. That's how I see this question actually.
Thanks. Mirko, can I stay with you? We've got a question coming in that it mentions the T+1 commences the day before a public holiday in South Africa, which has been declared a public holiday for national elections. What recommendations do you have in terms of risk mitigation?
Yes, if I'm looking at my calendar to make sure I get correctly the day. So I presume 28 is the first trade date for the US, and it's going to be set for 29. But on 29, maybe I'm in South African funds and I have to buy this US stock. How can I do the effect to find my trade? So it's the usual bank holiday problem that we are seeing these days when the other currencies close on the value date. This can be done to pre-funding, of course. So we were discussing before, how can you do that? You need to make sure that you can speed up your process, or maybe this is a news for someone, but as BNP Paribas custodian for the clients in custody with us, we have a solution for that. So in this case, the South African client can buy and settle even his ZAR leg on the 29th of May, that is bank holiday in ZAR. So he will have no issue at all to fund this trade for the FX. But if it's not done with your custodian, you may want to pre-fund, or you may have enough, again, credit line on your account, to make sure that the trade goes through anyway. So again, there are several solutions on the market, depends where do you want to rely. And again, it should not be the same for everything. You can take your cake of assets and differentiate it, give it something to someone, to help you to have a smooth transition.
Thanks. That's why everyone was pushing for that September date a while back. Barney, we've got one more question if you want to ask that around stats, and then if there's any more questions to shoot in, please do in the next few minutes.
Yeah, great point. So there was a question that came in around the stats I was saying at the beginning around FX outsourcing and pre-funding and whether or not those are broken down by region. I think it's, I think it backs up, unfortunately, the stats back up entirely what we've been talking about here. So pre-funding and outsourcing to custodians predominantly happening in Asia, and obviously largely on the mid-tier organizations as well. The bigger you are, the more likely you're going to have a global footprint and therefore to be able to manage these things internally. So I think Gabino's points around Asia, I think are very, very much borne out by the stats. But if anyone does have any questions on those, happy to dig into them offline if you want to just reach out and walk you through the statistics that we do have.
Brilliant. Well, look, pleased to have got through all the questions. Thanks for the audience questions in advance, and thanks for ones that have come in during the session. So we'll be posting this recording up on Global Custodian's website in the coming days. If you'd like to share it with anyone, we also write up the answers in our the Q&A transcript in our T+1 handbook, which is being constantly updated. We've got another webinar coming up in the coming weeks. We're not going to stop talking about FX and funding. If you've got any more questions on the topic, send them in and we can cover them in one of the next two sessions. But for now, just thanks everyone for listening. And once again, thanks to all our panelists for their thoughts and insights today. So we'll see you next time.
Thanks, guys.
Thanks all.
Thank you. Bye. Bye-bye.